Hey everyone, it's Kirk here again at Option Alpha. So in this video, I'm going to go through the 5 biggest mistakes that I see traders make when backtesting option strategies. I do see these happen often, so this is why I'm doing the video, because there seems to be a disconnect when traders are sharing backtests and trying to basically assess the validity of a backtest. And of course, backtesting is never going to be perfect with the future, but we can do a lot of things to improve the way that we backtest, and I hope this helps out. As always, I'll include links to all of these backtests that I'm using here as examples. I'm not recommending any of these strategies. I'm just using them as examples in this video. So again, take that with a grain of salt. They're just demonstrational example backtest ideas to help you improve your backtesting in different ways you can do it. But I'll add links to all of those right below this video so you can check it out for yourself. All right, so let's get into the first one. The first one is not including some sort of slippage in your backtest. Now this is really important. We added this a long time ago in the backtester, but you have to include, or at least consider including, you don't have to include it, you can do whatever you want, but at least consider including slippage as part of your backtesting. Now, it depends really on how your strategy is set up. So there's a lot of different ways you can do it, but for the most part, I think you should include slippage definitely on entry. So if you are obviously testing a strategy, you can include slippage on entry. So when you're getting into the position, assume you're going to have some slippage. You don't always have to include it on the exit of a position, because sometimes you maybe let the position expire at expiration and it's just whatever the total P&L is. But if you're taking a profit, maybe you also include some slippage as well. I've talked about this so many times, but it is so important because it shows the robustness of a strategy, like how resilient is a strategy to a little bit of slippage. So let me show you an example. So this is a strategy. Again, these are all just random strategies I pulled out and have kept for examples in doing this. This is just an iron condor position, an SPX 0DT trade. This one is trading, and this is, I think, the difference here is like this one is not trading an at the money position. It's not like we're trading very close to where the stock is. This is going to be an out of the money position. This is an out of money position later in the day, right? So this is out of the money position later in the day. And you can see it's a pretty basic strategy, right? And the P&L and everything looks pretty good up and to the right, you know, a little bit of movement here. But for all intents and purposes, if I didn't tell you exactly how this strategy was set up, like the actual details of how this strategy was set up, you might look at this chart and say, great, like decent strategy up and to the right, good profit factor, good win rate, high trade count. What's not to like about this strategy? However, if you include a little bit of slippage, things change. So here's how you would do it. By the way, you can just go into any backtest, hit the compare button here. That's going to go into basically comparison mode. And then you can add a completely different backtest to compare, or you can click the 3 dots here and add a variation. So if I add a variation, all it's going to do is it's going to copy exactly what the backtest is right now, and then you can make your changes and add a little bit of variation. So in this case, I'll include just slippage on the entry. So 5 cents of slippage, which is the minimum tick anyway for SPX positions broadly. So since we're not doing any profit taking, I don't necessarily have to include slippage on exit. It's just going to expire and be whatever the P&L is for the different backtests. So once you run that, then you get this. So this is how, after it runs, you can see this is the difference in the strategy. So it went from essentially a decent strategy like broad metrics to an okay coin flip. You could probably find some better strategies, right? I'm not saying that this is like something you can't trade, but you can see 5 cents of slippage made a considerable difference in the P&L. So you went from 1.25 profit factor to 1.03. The win rate was still about the same. You're still winning about the same amount, but your P&L went from, you know, about like $5,000 to $1,200. If we did 10 cents of slippage in here, and we could add it in here and just run it real quick while we're talking about it. But if we added 10 cents of slippage on the entry, which again, to me, is not crazy because you're trading a far out of the money leg, that's not always going to be at the end of the trading day for a 0DT strategy. It's not going to be the most liquid thing. People are not actively trading super far 10, 5 delta options at the end of the day. And if they are, you probably have to include a little bit of slippage. So let's do 10 cents of slippage. I bet this one obviously would turn it pretty close to negative or generally negative. But again, it's not a great strategy. Like, yeah, so it turns it negative. The average P&L goes from 7 to 2, of course, because you're just including that slippage in there. But you know, that's the thing, is like it shows the robustness of a strategy. And this is where I think a lot of people fail right off the bat. It's like, make sure you're at least considering slippage. Definitely on entry. On exit, if you're taking profits, I would start to include some slippage. Not that you're always going to get slippage when you are placing trades, not that you won't fill close to where you're trying to fill. But I would rather see traders when they're backtesting actually include some of this stuff versus like having the reality of a live market start to hit them later on when they think they're trading a profitable strategy, but a little bit of market like real world slippage basically knocks that strategy out. All right, so the next one that we're going to talk about is unrealistic position sizes. So this is basically number 2 of our top mistakes. This is not necessarily ordered in this direction. There's no like hierarchy necessarily, but this is probably a top one here too. So I've got 2 examples I'll show. Again, I'll add all of these links in the show notes in the description right below so you can take a look at these. Again, it doesn't matter what the strategy is for our purposes. I'm not recommending any of these. These just show some examples. These 2, I believe, were pulled from top bots or top strategies in the backtester. So if you go into the backtester, there's kind of like top backtests, which we don't filter out. We let you guys kind of filter that stuff out. This is where you have to decide what is valuable and not valuable. But these are pulled from this, and it just shows, I think, what I'm trying to explain here with having this like realistic, position sizing. So here's an example here for this backtest. Again, if I removed everything from this and I just showed you the P&L, right? And you saw $394,000 P&L and profit factor of 1.75 and win rate of $65. All of that would be great, right? Like you would think to yourself, why would this not work? Why would this not be a good strategy? So here's why I think it's completely unrealistic. The capital allocated in this backtest, and again, you can test whatever you want. So you can test tons of variations here, but again, just do it logically and rationally, right? The allocation here was $100,000. Okay, fine. And the position size, every single position was 300 contracts. That's right. So every single position that you got into was 300 contracts. So if you look down here on the risk column, you've got basically $100,000 positions every single day. Now, could somebody trade that? Of course. Is it realistic that you would actually do that? Almost zero. Almost 0% chance that you would actually do it, but we can't stop you from trying that idea. It's just a random idea. Maybe somebody does want to do that, right? But that's not a realistic position size. And moreover, what's not realistic about that position size is that you would actually get filled on that. So in this case, this is an iron condor, which means you're going to have to fill 4 times 300 contracts every single day. That's 1,200 contracts getting filled. And in this case, in GLD, I just don't think those options are that liquid that they would fill every single day. Okay, here's a different example. Here's SPX. Everyone here says, of course, SPX is the most liquid, which is true for the closer in options. But you start getting to these further options out here, like this one is testing, that doesn't necessarily mean that it's going to have good liquidity. Now, this test also doesn't include any slippage, so that's another ding to it as well. But here, what you have is you have a $100,000 position, and you're testing 25% of your capital for every position. So again, when you look at the position count here, you're looking at basically like $25,000 positions and increasing as it goes up. I just don't think that's a realistic strategy. So does the strategy look like it's okay? Sure, but just test it with some more realistic stuff. So what we might do here is we might go over and say, okay, let's just, again, make some variations. I'm going to test this on the fly. I don't think that you would, I would start with just like 1 or 2 contracts. Starting value here can be significantly lower. So let's test maybe $10,000 at the very minimum here. You can keep all the other stuff the same, include a little bit of slippage on the way in. Because you're having exit options where you have this like touch filter here, I would include some slippage on the way out too. There's no telling that that's going to always fill exactly at mid price after you hit your touch stop, essentially. So then you could run this backtest this way and it might get slightly different results. All right, so here's the results after that backtest ran, and you can see the difference that just a little bit of what I would say would be more realistic real world adjustments in your backtesting would be. And the P&L difference is obviously significantly different, right? So when you start to include some of these things, and I still even think this might be hard to get, like this could be hard to get filled all the time perfectly, but it might be pretty close, but at least you would have, that realistic expectation that this is probably a more realistic scenario that you would find yourself in is strategy B. I'm not saying that this is going to work or not work. You be your own judge, but you can see the difference that you have here just by including a little bit of slippage and then actually allocating appropriately and not having these crazy allocations that are just out of control. And my goal is not necessarily to get you to find the perfect strategy or a profitable versus a loser. It's just to get you to find more realistic testing that you can do moving forward. Okay, so next one that we have here is just unrealistic rules or strategy, timing, or setup. So here's a really good example of this. This comes from the Backtester. This is one of the top backtests in the community for P&L or profit or one of the cases. But it really is a pretty unrealistic strategy idea. Again, we don't filter these out because we can't filter everything out. We don't want to advise on what is good and what is not good. We're just going to show you the results of what people have tested. But this is just a good example here because, again, if I just told you all of these numbers, like profit factor is 6 and P&L is $5 million and win rate is whatever, you'd be like, yes, of course, let me quit my job and do this. But some of these rules just don't make sense at all. So this one is a classic one. We see this all the time, which is trade entry at 355. So just remember, and to even stack on top of that, you have position sizing of $25,000, right? So that is really, really incredibly hard, right? And on the Qs, there's nothing that tells me that any of these trades would fill. Like in a real world environment, there's pricing for it historically. So technically you can test it, but that particular combination, there's really nothing that tells me that any of these trades in a real world environment would actually fill. So there are a couple things that are wrong with this. Number one, I think if you're trading on the Qs, there's assignment and expiration risk that is real and valid for that size of positions. Nobody is going to take the opposing side of this trade consistently. That's why no one's going to take a consistently opposing side 5 minutes before the market close and give up essentially $5 million. They're not. There's an unknown risk that's just not factored in the backtesting, which is the real assignment and expiration risk of QQQ, that you could be assigned all of those shares on one side. Those deltas, even though they're not super far out, a 30 delta 5 minutes before the market close could be significantly far out that there's no liquidity for that, right? So again, you have to ask yourself, who is taking the other side of these trades? And I just don't think anyone realistically is going to take that big of risk, right? And take that big of a position size literally 5 minutes before the market closes. To say nothing of the fact that this doesn't even include any slippage or anything like that on entry or exit is neither here nor there. But again, it's just an unrealistic expectation of what you should be doing for testing your strategies. All right, so number 4 on my list here is essentially stopping at win rates and P&Ls. And what that means is that a lot of people, what I think they do is they just look at backtesting in a very small vacuum. They just look at one metric, maybe 2 metrics, and they don't include the totality of a backtest. So basically all metrics that build a profile of the strategy, and more importantly, how that strategy fits with other strategies you are currently trading or potentially backtesting and trading as well, which is really important because none of these things are going to act in a silo. They're not going to be by themselves. They're going to be incorporated into your overall portfolio, which is why I know I've done this before in other videos, but I show you combined backtests of all the different types of strategies that I'm running for, say, a 0 DTE strategy. So I can see for myself and I can show you guys how those different strategies work together. So here's a good example of this. Somebody, I think, had posted this or a variation of this in the community a long time ago. I had a note on this to include this in this video. But basically what this is just an SPX long put at 230 under certain conditions. So long 30 delta put, 230 includes some slippage, which is good, right? And it's basically trading basically every day at the end of the day by this far out of the money. I think it was like a 5 delta, something like that. And it had a pretty simple little entry filter. So basically if the change on the day was essentially positive, then don't get into this position. Like don't hedge a positive day, right? Now in and of itself, this is like dud-ish strategy. If somebody saw this and they're quickly flipping through stuff, they say, okay, dud strategy or mostly dud strategy, you know, low P&L, high max drawdown, profit factor is okay, win rate's not even 1%, you're just not even getting anything. You're just basically burning money hoping to get a big, you know, couple of these little wins here and there that are big wins that kind of pay off for the rest of the strategy. That's fine. However, what you should be including in your backtesting or should be thinking about as a trader is how could I incorporate this into something else? Or how could different types of strategies, even if they don't work by themselves, do they enhance the effectiveness of a different strategy? So here's an example to use an SPX iron condor at 240 in the afternoon. So this example I ran, again, I'm not suggesting you do any of these. I'm just using this as a learning example. But this one is a long put strategy run at 230. This one is a iron condor strategy run at 240. I deliberately spaced this out by 10 minutes because what I want to do is I want to see, is the market down on the day? And if it's down on the day, I would get into the long put strategy. And essentially, I would, potentially avoid or not trade the other strategy for the day, right? So you can do different combinations of this. But if you look at this individual SPX strategy here, this strategy number A, it's an okay strategy. I'm not saying it's an amazing strategy. I'm just using it as an example. It's got a decent win rate. It's +1 profit factor. Total P&L is good, right? So it's fine. However, if you combine the results of these, and let's say you only open test A if test B is not open, right? Or just do different combinations of this. But what you see is that it actually enhances the combined portfolio by using the strategy number B, which is just a long put strategy, in addition to strategy number A with some just very simple rules on which one gets opened or not. And so this is really, really cool, is that you can actually do this and say, okay, strategy A is this, strategy B is this, and the combination of these is actually a better, potentially a better P&L curve. And at the end of the day, it's actually a little bit higher than the rest of them. You can see it improved the profit factor on this. Your win rate obviously went down because it was drugged down by this one. So I don't know, you kind of, take that with a grain of salt. You know that you're, adding a strategy that's just kind of a little lottery ticket here. But look at your average P&L on trades went up to $12 instead of $9. I mean, it's just, this is what I try to incorporate a lot into my own backtesting, is like, how can I incorporate this strategy with something else I'm trading? And notice in the comparison here, we have two completely different strategies that we're testing. It's not always that you have to do variations of the same iron condor or credit put spread or credit call spread strategy. You can mix and match and combine different strategies together to see what the total combination comes up with. And that's really important. It's like trying to figure out what the combined portfolio or strategies that you're trading ends up with versus just focusing purely on one backtested win rate or one backtested P&L. I think that sometimes people miss some of these, for lack of a better term, like diamonds in the rough, these things that could be incorporated into their strategies moving forward. Okay, so this last one here is a really fun one, and it's number 5. And number 5 for me is this concept of trying to eliminate all possible loss scenarios. So it's very common in backtesting for people to look at a backtest and say, oh, well, why did I lose in this scenario? Let me eliminate that potential market environment. And then let me eliminate that potential market environment. And then the other one, and then the other one. And sometimes you run into a scenario where you've eliminated all possible opportunities to make any money and you just don't trade enough. But this example here, I hope, kind of proves the point to a certain degree that it's not necessarily about eliminating every single potential environment where you could lose money, because sometimes those are the environments where pricing actually compensates for your trading strategy. So here's a really fun one just to go through as an example. So this first strategy here that I actually threw up, this is actually the first one I tested and then I reorganized them, but you can see what the difference is. But strategy number C here is, and it's all the same iron condor strategy. So just to be clear, it's the exact same iron condor strategy across the board in this example. But in strategy number C, what I was doing is I had some filters to avoid what I called big volatility. So VIX percentage changes from 0 to 5, right? So if we had a big VIX day, then I'm going to avoid those, those up days in volatility. So where volatility kind of ticks up for a little bit, right? And what you see here is you see that that was not a good idea. I mean, yeah, you avoided potentially some bad days here and there, but generally speaking, it was really the worst performer. Then you have this one here. It's one of my favorites to test and show, but in this case, I skipped all of the big market events. These are big things that everyone always says, we can't trade on these days. It's too volatile. It's too this, it's too that. Okay, fine. So skip FOMC, skip CPI, PPI, PCE, non-farm payroll, triple witching, whatever. Skip all of those event days. Okay, you actually did better doing just those skips and avoiding the big volatility days, or including the big volatility days, than you did, right? So the comparison here, you got better. But here's one that's really interesting, which is just avoid nothing. Like, take everything that comes. You have no avoiding, no big volatility days, no market events, like trade through everything. Trade through Fed, trade through CPI, trade through PPI, trade through everything. And that ended up being the best strategy. That ended up being the strategy that ultimately was the best one at the end of the day. Had the best P&L, had decent profit factor, had the best win rate. You go down here, had, really good return on risk. It had really good P&Ls and like risk. It was the best strategy that you could possibly trade. It's just trade everything. And it's the simplest one. So it makes sense for a lot of reasons why sometimes the simple things actually work. You just had a lot of trades and you just traded through lots of environments. So this one's really fun because, again, there's a part of me, and I know you as a trader as well, is like we try to avoid those crazy market environments. But sometimes in your testing, don't avoid or try to filter out everything. Don't try to curve fit it into the perfect environment. If anything, I like the idea of a strategy that can trade through everything, that is robust enough to not be knocked out by all these different little things. That to me is a very fragile strategy that can't trade through some of these environments. So as a baseline, I love to test my strategies and to include all my strategies with all of these market environments because we just don't know what's going to come anyway. And so we can't filter out everything. So I hope that this video helped out kind of going through these 5 different mistakes that people make with their backtesting. And I hope you can include some of these now moving forward in your own backtesting. I'm sure I missed some other things. So if you want to add it in the comments, feel free to do so. If you enjoyed this video, please let me know. Give it a like, share, subscribe, share it with your friends and traders. And until next time, happy trading.